So this may be a little stream of consciousness. So what is TEK2day? So TEK2day, founded in 2018, started off as a podcast strictly about technology and CEOs because it was a complement to our initial fintech product, the CEO Rater database, whereby we scored CEOs, public company CEOs. And over time, we added on a consulting layer, which is the primary business today. Would like to dedicate more time to the YouTube channel to complement what we write. On the content side of the business, most of what we create is, in fact, written content. And you may find that at Substack, where we are TEK2day at Substack, TEK2day. And we cover technology, we cover the capital markets, we cover fiscal policy, we cover monetary policy. As I said, in 2018, the focus was primarily technology and to a lesser degree to capital markets. I spent most of my life around the capital markets and the software industry. And then in 2020, when COVID hit, the fiscal response was so enormous, unlike anything the capital markets or the U.S. economy has ever seen. There was so much stimulus pumped into the markets, both on the fiscal side and the monetary side, that it just changed everything. Changed this business. And frankly, it's just bad for the country, that fiscal and monetary response, where we've become really a socialist light country. I guess you could say that started under FDR, was accelerated under LBJ, accelerated under Obama, and then really accelerated under Trump and Biden. And so that's why we rail so often in our writings about fiscal and monetary policy. There is no free lunch. Mailing checks to people is not a good thing, as was the case with the 2 rounds of stimulus we had in 2020 and 2021, because there is a tax, the inflation tax, which everybody has suffered through. You don't get to vote on the inflation tax. Doesn't matter if you're an American citizen, if you're an immigrant, if you're an illegal immigrant, anybody who lives within the United States and has to live day to day here, you pay the tax in the way of inflated prices on goods and services. And so our writings of late have been around the fact that the Fed has not won, the Fed has not fought inflation, the fact that price increases, i.e. inflation, is slowing and is slowing toward the Fed's 2% target. That's not a win because prices have gone up so dramatically in the second half of 2020, all of 2021, all of 2022, and they're still climbing today, albeit at a slower rate. So we haven't had deflation. You can't believe the CPI numbers. They're bogus. And I'm not telling anybody anything you don't already know. If you go to the grocery store, if you bought a car, if you bought a house, big ticket and small ticket items are all up much higher than what the federal government reports. The trick that the government, there's a couple of tricks that the government does with respect to the CPI in terms of how they fool the markets and fool Americans as to things not being as bad as they really are. So, for example, one of the tricks they like to do is weight certain items less than what those items really would be for the average American family. The average American family, I don't know, what's food, what's groceries, family of 4. Is that half a monthly expenditure? Is that 75%? I don't have kids, so I don't know. But if you look at CPI, it suggests that food is roughly a 10% weighting. I would guess that every American family is spending a heck of a lot more than 10% on food and related items. So underweighting large expense categories is one way that the government likes to play tricks. Food is one that 2021 by food bill up about 40%, 2022 the same, 2023 not quite as much, I'd say 15% on average. If you're like me, you remember a time when I think eggs went up 8x here in the Northeast. That's what I remember. But if you follow the government statistics, I remember I wrote an article on eggs specifically last year. And the number at that time that CPI was reporting was an 11% increase year over year. So it's just, it's off by a factor of 7 or 8 in that particular instance. The other trick that the government likes to do is when they publish CPI, they assume that consumers rotate. So instead of measuring steak, for example, let's say grade A steak year over year, what they'll do is they'll say, well, the consumer steak is up so much, the consumer probably would have rotated down to ground beef, let's say. And so we're going to change the weighting. In the meat category, it's going to be less steak, more ground beef, and therefore the price increase, the real world price increase for the meat category has been muted by the way the government manipulates that price data. So inflation is much more severe than what is reported. And that's why I've been saying for well over a year that inflation, that a recession's baked in. If you read our stuff, I've been saying since 2022 that we've been in a recession. The way the government calculates GDP and therefore whether or not we're in a recession is they take the nominal GDP and they back out the GDP deflator, which is a fancy term for price increases. And nominal GDP less price increases is real GDP. But the price increases that the government backs out are significantly understated, and therefore real GDP is significantly overstated. So I believe we've been in a sort of a mild recession since 2022, and that real GDP has been flat to negative during this period. I think it's about to get a whole lot worse. One of the things we looked at today, we wrote about earlier, and I put out a little 2-minute video about it, is the reverse repo facility that the Fed has had for a number of years, but that really was tapped into for the first time at scale in 2021. And so the reverse repo facility the Fed created to give bank and non-bank institutions a place to park surplus capital overnight and to earn a return on that money. So that should not exist, in my opinion, because now you have a government agency, the Fed, competing with private markets. Let bank and non-bank institutions go park money with private parties overnight to earn a return. Doesn't have to be with the Fed. But anyway, that's the reality. And so if you look at the reverse repo facility, it peaked on December 30th of 2022 at 2.6 trillion. So that implies that there was 2.6 trillion of excess capital at that moment in time. And so that would suggest 2.6 trillion of excess liquidity in the system. And that number has since fallen off steadily. And as of, I didn't check today, but as of last night, November 30, that figure was 887 billion. So my thinking is that the Fed, as they tighten the money supply, as they reduce the money supply through QT, they're pulling liquidity out of the system. And as they pull liquidity out of the system, obviously, excuse me, banks and non-bank institutions have less excess liquidity, and therefore they have less liquidity to park overnight at the Fed. And so the question is that everybody's been asking, institutional investors anyway, is when will the Fed pivot? And that's the question both for the Fed funds rate and both for QT. When will the Fed stop QT and potentially pivot to QE, quantitative easing? I don't have a good answer about QE in terms of when the Fed may stop QT. I would guess that once that reverse repo facility gets a lot closer to zero, I don't know exactly what that means. I don't know if it's 300 billion, 200 billion. I don't know if the Fed would take it to zero. But my guess would be as that excess capital in the system, that slack, works its way down to zero, the Fed's going to put the brakes on QT. And I would also guess, I didn't talk about this earlier, but I would also guess that something probably breaks in the system on the way to zero. Maybe we have another sort of bank crisis with deposits like we did back in March. We would have had that hard landing in March of this year had the Fed not stepped in with the bank term funding program and bailout. Had that not occurred, we would have had a hard recession. We would have had deflation. We would have got prices of goods and services way down. That would have sucked excess capital out of the system, which needs to happen. It would have been painful, but it needs to happen. There is so much excess capital sloshing around the economy. Prices are so darn inflated for big ticket items and small ticket items. That needs to be rectified. And so it would have been painful, but it has to happen because we found ourselves now in a situation with all this printing, with all this excess capital. We've ballooned the debt to 34 trillion. And the interest on that debt is approaching a trillion. If you look on a calendar year basis, we're on an October fiscal year in the United States. But if you look on a calendar year basis, we're approaching a trillion in interest expense on the debt. And that number is going to be a bit higher next year. It's going to be a bit higher next year. How much higher? It's uncertain. I think we run a similar deficit. So in fiscal 2023, we were in a $1.7 trillion fiscal deficit. I think we'll probably run something similar, maybe even more in fiscal 2024. You've got an election year. The Biden administration is going to want to push through stimulus to get the economy, well, to give the appearance that the economy is doing well. I don't know that the Republicans will push back. I know that that's the bet, but the Republicans aren't going to want to be seen as the bad guys. They're going to want to give the drug addict the goods, and the American economy is the drug addict. So I don't see them pushing back on a Democrat initiative for fiscal stimulus, and we don't have a debt ceiling. So maybe we're looking at a $2 trillion deficit for fiscal 2024. And therefore, there's all the more rationale for the Fed to lower the Fed funds rate, get the interest rate down, because otherwise the interest expense is going to be absolutely enormous. If you're looking at, let's say, a 37-ish debt mountain at the end of fiscal 2024, we can't afford to have the average interest rate on that debt continue to climb. The debt's climbing. You don't want the interest rate to climb as the debt's climbing, as the principal's climbing. The average interest expense, I haven't looked in a couple of weeks. As of a couple of weeks ago, it was 2.3%. It was a hair under 3%. And so a significant chunk of that debt is short-term paper. As that rolls over at higher rates, you've got sort of medium-term paper that's going to be maturing. That's going to roll over at higher rates. So there's going to be a big incentive for the Fed to get rates down next year. You've got a fair amount of commercial real estate debt that's going to be rolling over next year, a fair amount of corporate debt that's going to be rolling over next year at much higher rates. For the CRE market, the commercial real estate market, the big year is 2025. But nonetheless, there'll be commercial real estate owners that are going to feel pain next year. that are going to have to roll over debt at higher rates or issue a bunch of equity and pay debt down. I think you're going to see a lot of companies do that, frankly, across sectors. Some companies will be happy to roll it over. Companies that generate a fair amount of cash flow, they'll be happy to roll that over at higher rates and wait out the cycle and wait to see interest rates come down. There'll be other companies that won't be able to afford to do that, and they'll want to pay their debt off, and they'll issue equity. So you'll see, I believe, a fair amount of dilutive equity deals in 2024, not because companies are performing so well and their equity valuations are through the roof, but because they don't have a choice and they need to pay their debt down. So I think you'll see a fair amount of that. I would expect Q1 to be soft. I'm thinking now about the technology sector, my old sector. Software companies, I don't care whether it's consumer tech, enterprise software, application layer, infrastructure, frankly, even hardware. It's just what's the incentive in a moment of uncertainty? What is the incentive to give bullish guidance? I can't imagine pipelines are going to be exceptionally healthy. I think a lot of corporate buyers are going to tighten the purse strings. If you don't know what Fed policy is going to be in terms of rates, you're going to want to maintain a conservative stance. If you're a management team that believes the Fed's going to take rates down pretty quickly in Q1, and if the Fed doesn't, you're going to be negatively surprised, and you're really going to have to slam on the brakes. I don't know how many management teams are left who are bullish about rates early in calendar 2024. I think during Q4 this year, more management teams got religion around the Fed being higher for longer. I think that's definitely the case. So we'll see how that plays out. A lot of CEOs, a lot of management teams, this is their first rodeo with higher rates. 2009, when the Fed took rates down, if you're a CEO and you're 40, 50 years old, you probably weren't in the chair the last time rates were elevated. So this is a new experience managing through a higher rate environment. So in any event, a lot of uncertainty in the economy. You can check us out on Substack. I mentioned earlier, we just rolled out a premium offering, by the way. I'd say half the content we're publishing today is premium, $9.99 a month. $9.99 a month or $99 a year. And on that stuff, you get sort of longer form articles, the occasional spreadsheet, you get more data. And it's sort of an a la carte basis. You don't, it's not as if you lose out on 80%, 90% of our content. If you don't opt for the premium product, as I said, half of the content is still free. And on the premium stuff, we give you a little teaser. You get like a paragraph, so you can kind of get a flavor for, what the premium articles look like before you decide to subscribe. And then we have a 7-day trial. So if you're thinking about premium, you can pop on to TEK2day on Substack, sign up for the 7-day trial. And if after 7 days you like the premium article, great. You can subscribe to the premium service. So in any event, that's all for now. Have a great weekend. We'll see you next time.